It's exciting. Let's talk some housing today, Mike. I guess the question I'm going to pose for us to discuss is this a housing boom, a housing bubble, or perhaps something more sinister? The housing market, I mean, there's no argument, it has been on fire. And in even given what recently happened today with the new housing numbers, it's still been an incredible housing market. So let's talk about all the details of what we've seen here, and let's start with the recent housing numbers that were released today.
Yeah, we had existing home sales data for the month of March released today and saw a month-over-month decrease in home sales. And you can start to see this in this chart here. The blue line is existing home sales. So you can see a little dip, but obviously this is following the rapid increase in existing home sales we saw through COVID. And as we go through this discussion, there's a tremendous amount of debate as to whether this increase in prices we've had and the housing market being on fire, is this primarily a supply issue or a demand issue? And these things are very hard to disentangle. And we're to the point now where when you look at the decrease in existing home sales in March, and a lot of it is being blamed on not a lack of buyers, but just a lack of properties, just a massive supply shortage that is now starting to impact demand.
Yeah, I guess I would argue perhaps that it's both a supply and a demand issue. I think that what I've seen, or what we've seen here, is there are some new buyers in the market, and we have a large number of institutional buyers that weren't in the market previously, and they're buying up a lot of homes, and in some cases, entire neighborhoods. And we're seeing sort of the financialization of the housing market, where the institutional money is in here, and they're just bidding all cash offers and taking properties away from individuals who are trying to buy a house. I mean, we've seen it locally here. We've seen it anecdotally from some of our clients who have been trying to buy houses, that they're just getting outbid in all cash offers, sometimes 30% above ask price. So it's a unique environment right now, and I think there's a lot of things in the undercurrents that might be worth discussing in terms of what is changing, or what is different this time in the housing markets. Let's talk about the market itself and how the sales to list price ratio has just been changing and climbing.
Yeah, we're looking here. If you focus on the red line in 2021, this shows the median home sold, what it's sold for relative to the asking price. So the median home sold now is being sold for above ask, 100.2% of the ask price, which is a record. We've never seen anything like that before in the history of the data. And you really attach this red line onto the end of the blue line, because the blue line is 2020. And you could see we started out 2020, homes being sold about 98% of ask, which is about normal for a healthy housing market. Started to cool down in the winter, as you might expect, and then just this spring going up rapidly. So, you see news headlines like this: homes getting sold for 120, 130% of ask, all cash offer in 5 days. Yeah. Half of the homes sold this year have been on the market for less than a week.
Yeah, that's what we're seeing from some of the realtors that I know. They're actually just limiting the listings to a week, and sometimes only like 3 or 4 days, because they're just crazy number of offers coming in.
Right, and more pocket listings that never make it to the MLS.
Right. Yeah.
So really unprecedented in terms of the speed of these homes getting sold and the price relative to asset they're going for. And it's not like the asks are too low. I mean, housing prices year over year are up double digits. So people are marking up prices, and it's still just not enough.
Yeah, and maybe speak to any of the bifurcation from the sort of the high end of the market to the low end of the market, because I think we've seen housing over $1 million is accelerating rapidly, whereas below $1 million isn't trending as much.
Yeah. So there were definitely different cycles to this. As we started out COVID, a lot of the demand was sort of at the lower end of the market, and you were seeing a lot of demand there. And saying, oh, look, people are looking to get out of cities and move out into more rural areas, and maybe they're just looking for a modest type home. And that has changed now. And we're even seeing very strong demand for larger, more expensive properties, and some even in places like Manhattan, which is totally different from what we saw early in COVID. So it's pretty widespread now, and it's definitely picking up at the higher end of the market as well.
Yeah, so let's dig into that. So, I mean, there are a lot of people who are buying a second home, perhaps, and I think we have some graphics on that to discuss that. But there's also a heavy concentration of institutional investors now in the market, and they're
Yeah.
just buying indiscriminately, and they are typically, all cash. They're funded by pension funds and other institutional investors, and they're all cash, and they're looking to generate income because they're wanting to. It's sort of like the financialization of the housing market is the new bond market for generating income for some of these institutional investors. So,
Yep.
what do you think about that, and how should we think about that in terms of what's happening with these prices?
Yeah, that is definitely a new entrant to the market that is significant. So you think a lot of it has, yes, institutional, but a lot of it is even foreign institutions. So things like sovereign wealth funds. And the asset class that you're talking about is the single family rental asset class.
Mm-hmm.
So traditionally, you look at a sovereign wealth fund, and they have a tremendous amount of money to invest, and they want to, spend 5 million or $5 billion relatively quickly and easily.
They want to be
And
your landlord.
right.
Yeah.
And so historically, what that meant is they would just buy an office building in downtown Manhattan. But now, and they wouldn't typically participate in the residential housing market because these sovereign wealth funds don't want to go through the trouble of dealing with realtors and having to close on 50, 100 homes. And it's the legwork. It's just not an efficient way to spend $5+ billion on an investment, right? So what's happened is you have organizations here in the U.S. that will do all that legwork for the sovereign wealth funds, for the foreign investors, and they're even partnering with home construction companies. And so the sovereign wealth fund will say, "Hey, I have $1 billion to spend on single family homes. Just go and build them for me,
Right.
and then I'll rent them out."
Yeah.
And so
Like
that
whole neighborhoods in some cases. They'll just
exactly.
buy the whole neighborhood. Yeah.
Exactly. Yeah. So that's a new asset class, and that is definitely, when you think about how these trends start to normalize, big blocks of demand, prepaid demand, um, should clear up a lot of supply constraints and allow home builders to really accelerate and make investments in increasing supply. A home builder who's selling homes one by one over time is going to make different investment decisions and build out new homes far differently than a home builder that thinks, oh, I'm going to get a $5 billion order,
Right.
every year. That, hey, if this is coming, I'm going to invest in capacity, and I'm going to rapidly pick up supply. So that new entrant definitely changes a lot of the dynamics.
Yeah, and I think that's what I was referencing when I said boom, bubble, or something more sinister, because it's going to change the landscape if you continue to see these institutional investors rush in to the market. It's going to just change the entire landscape of the housing market. So let's take a look at supply, though. We've got a graph here that looks at supply and dig into sort of, where, why we're suffering from such low supply.
Yeah. This is how supply in the housing market is typically measured. So this is months of supply of existing homes. And so we're down at 2 months of supply. And a healthy number is viewed at 4 to 5 months. And you can see during the global financial crisis, when the housing bubble burst, we got up to almost a year's worth of supply. So you look at this chart and your initial takeaway is, well, we just need to build more homes. There's just not enough supply. But this is where it goes back to, it's very difficult to entangle whether this is primarily a supply thing or a demand thing. The truth is probably somewhere in between, because even when you look at the calculation of this figure, what you're doing is taking the total number of homes available currently and dividing them by the number of sales last month.
Mhm.
So if sales fall, even if new homes don't come onto the market, months of supply will naturally increase. That's why you see a tick up here very recently, not because, supply actually increased, but just because home sales cooled off a little bit.
And this does not include pocket sales or sales that don't even hit the market.
This is everything that's on the MLS.
On the MLS.
So sometimes that means that pocket sales would not be recorded.
Right, right.
Yeah.
So in terms of supply from, after we sort of emerged from the financial crisis in 2008, it looks like supply has just been trending down, however. So you could argue that we do have perhaps some type of structural supply issue to deal with.
For sure. There are definitely a couple things just on the supply side. People are staying in their homes for longer.
Mm-hmm.
So the average amount of time that someone stays in a single family home now is up from somewhere around 7 years to 13 years. And these are primarily baby boomers, so older generations just deciding to stay put. And you could see how COVID could definitely accentuate that factor. If you have your home, yeah, that'd be great. I can sell my home right now and get a great price for it. But then I have to deal with going out and trying to buy a new home, and that's almost impossible right now. And I don't want people coming through my house during a pandemic.
Right.
Fair enough, right? I don't want an open house during a pandemic. So people generally just staying put. So that's structural accentuated by COVID. And then the other factor is just not opening up enough new residential zoning to build new homes. So
Yeah, I think people don't understand it takes a while to build houses. It's not a simple, you just turn the lights back on in the factory and pumping out the widgets. Like it takes a long time.
right. There's getting it approved, getting it zoned, getting the sewage up to code, getting all of the connections in terms of broadband and other utilities. All that stuff takes a long time. That's not something that we can't deal with in this country. If there's demand, we should be able to meet that. But you could also see how that could be slowed down by COVID,
Mm-hmm.
where it might just be harder to secure those approvals, just given the environment. So there are definitely supply factors here. The other thing, going back to what we just said, just build more houses. It's just not that easy, right? And there are definitely supply and supply chain issues and input cost issues for home builders that are very acute. Lumber, I think, is sort of a microcosm here. This is probably the one that gets the most headlines. So this blue line is the price of lumber futures. So lumber, processed timber that's ready to be built, all-time highs. This chart looks similar to Tesla stock. Obviously, correlation, no causation. But during the pandemic, you can see how much lumber increased. So why aren't we just supplying more lumber? Because actual timber, so unprocessed lumber, that's the green line, those prices are very low.
Mm-hmm.
So we have excess timber, but a shortage of lumber, right? Seems like this shouldn't happen, but what you have are lumber mills that have not increased capacity. They're dealing with labor shortages. It's
Yeah,
very
a lot. Yeah, a lot of them went. A lot of the sawmills went out of business in the last crisis, and there's just not that production capacity
exactly.
that's in the market. Yeah.
Exactly. And it's very hard to find labor right now, and they're offering large bonuses to try to get people to come in and work. And so we can get all this timber processed. But we're just working through all that.
Yeah.
These are the things. It just goes back to the point that we've made previously. It seems like it was far easier to shut down the entire economy than it is to turn it back on again. You're dealing with all these supply and cost constraints and labor shortages and things like that. But once again, if you are operating a lumber mill and you see this demand, you're thinking, I need to make investments in my capacity. That's fair. But if you see big block demand, huge chunky demand from foreign investors, that's when you should be thinking about accelerating your capacity increases. So that's where we think that that type of demand, the institutional buyers coming into the single family rental market, that could potentially change these dynamics, and allow this lumber shortage to hopefully be alleviated, and these companies to really feel comfortable making long-term fixed investments in increasing capacity.
Right. Yeah. And it translate. I mean, lumber is one element of it, and there's a lot of other building materials. And if you can look across the board, even steel and aluminum, they're all sort of following the same path here. Let's move on to actually look at supply and how it has trended since we came out of the great financial crisis, and what we're seeing in terms of new housing starts.
Mm-hmm. Yeah, new housing starts definitely bottomed in '08 and have been increasing at a pretty steady pace since then. And so you'd say, oh, well, we are building new homes, so this is not a supply issue, but once again, it's very hard to disentangle these things because we know prices have been increasing at a much faster pace than new housing starts. And we know that we talked about institutional foreign demand for single family rentals. If you're going to buy a huge block of new homes, a huge block of homes, they're probably going to be new. That's just the easiest way to do it, right? You buy a whole neighborhood, go through and try to buy existing homes in a neighborhood as they become available. So we're clearly not meeting the demand in terms of supply. And then generally speaking, millennials are coming into prime household formation age, and they generally want a new home. So we're making progress here. Certainly new housing starts have rebounded since COVID, but the point is the price doesn't lie. Clearly, we're not meeting demand. We need to increase new housing starts.
And there's been a great number of new entrants to the market, speculators who are institutionalizing the speculation market, where they'll go and buy 200-300 homes in different areas to build a portfolio of homes that they can then flip and or rent out, and then have them supported by investors. And that's a new entrant to the market that we did not have back in 2008. So that'll be interesting to see how that plays out, and that could also create more demand. And I guess the question is let's move to the demand side of the equation. So how much of it really is demand being pulled forward versus how much is just speculation that's creating excess and perhaps a bubble?
Yeah, it's tough to say because if all of the demand was for a primary residence, then you would feel more comfortable saying, hey, this is just positive fundamental news for the housing market. But we know demand for second homes has increased far quicker than demand for primary residences. And this is something we also saw in 2004, 2005. People buying second, third, fourth homes. We know you can only live in one home at one time. Anything beyond two for a household becomes more of an investment than it is necessarily, primary dwelling. So it's difficult to say how much of this is, hey, people looking at their balance sheets. They have a tremendous amount of savings. Their balance sheets are in really good shape. The housing market is on fire. Maybe I want that second home in a more remote location, just nice to have. Or maybe, I kind of want that and it's a good investment opportunity. Or they're looking at tax situations and don't like necessarily where the puck might be heading in terms of taxes, and say, well, it'd be nice to get that second home in a lower tax jurisdiction. And then maybe in a few years, I'll sell my primary residence and be a full-time in Florida or Arizona or someplace like that. So yeah, this chart definitely suggests there certainly is some speculation. It's not all just primary residence is on fire,
Yeah, I saw a stat this morning in a research paper I was reading that in the last year, 25% of the homes purchased were not moved into,
Hmm.
which Which, if that's the case, that would, I don't know how I didn't dig in yet to how they calculated the statistic, but that's sort of the headline, and that's what's going on. That would say there's a lot of speculation or a lot of institutional buying that is being prepped for rental.
Mm-hmm.
And it'll be interesting to see how that plays out and what that potentially does to prices. If you have this quick run up in speculation, how does that impact prices?
Right. Yeah. And that this chunky demand we're seeing institutionally for buying these homes and then flipping them for rentals, it's all seeking out income in a low income world, right? Interest rates near all-time lows. And so you can see how that impacts the demand side of this. Obviously houses are more affordable because mortgage rates are low, but at the same time, if you're a big sovereign wealth fund or a big institution and you're looking at the bond portion of your portfolio and saying, how am I going to get income? How am I going to meet my liability? Single family rentals, and it keeps
Good
up with
business.
inflation, which is great if you're worried about inflation as well.
Let's take a look at the affordability index. I think there's a lot of misconstrued headlines out there about, oh, rates are rising, so you're going to crush the housing markets.
So the housing affordability index, you start to think about how this starts to play out. The housing market should normalize. If home prices keep rising at this pace, then homes will just be less affordable and there will be less demand and people get priced out. And that may be true, but what we've seen here recently is even though housing prices are going up quite dramatically, housing affordability has not really budged. It's been pretty stable. It really hasn't moved much since '08. So houses are still relatively affordable. Now, if you assume, which is what we've done with the dash line, that over the next few years, mortgage rates revert back to their long-term average, then you can see how at these current prices, housing affordability would go down quite a bit. So people could start to get priced out. And this has a couple impacts. One, you have to think how reasonable of an assumption is that. And right now we're in the camp that that's not that reasonable of an assumption. Interest rates are going to stay lower for longer, and most likely. So it's probably not reasonable. And the second thing that this does is it just takes demand from the future and likely pulls some of it into the present. Whenever you speak to a realtor, they say now's the time to buy because mortgage rates are going up, right? But the reality is everybody knows mortgage rates were at all-time lows. And if they were thinking, in the next few years, I want to move out, well, they could take that demand from the future, pull it into the present, say, let's do it now while I'm certain rates are low.
Yeah, just yet another reason for the Fed and the Treasury to keep rates low, because if you see housing affordability run away from the middle class, you're going to have a lot of social unrest relating to that.
Right. And you can also price out institutional buyers, because if the homes that they're buying get so expensive that the income they get from renting them is unattractive relative to their initial investment, well, then not an attractive asset class anymore, on par with buying mortgage bonds or something like that. So
which would then, which in that case, most of them would dump the inventory back in the market, which would crash the pricing.
Right. Exactly. Many ways this could play out. These are mortgage originations by credit score. And so this goes back to something we said earlier, is this a bubble? Well, it certainly looks far different than the 2000s, right? Those darker bars, those cohorts are all lower credit score cohorts of mortgage originations. And we haven't really seen an increase in that. So what that means is banks don't have to go to fuel this demand is not fueled by banks going out and extending mortgages to anybody that has a pulse, which would be, you would deem that to be speculative. So not very supportive of the fundamentals. And I think this also speaks to, well, what's the credit score of most people right now in the country, given that their balance sheets are the healthiest they've been ever. Savings rates are the highest they've been in history. So just generally speaking, people have higher credit scores now than they used to. And then what's not captured here is obviously these sovereign wealth funds and institutional buyers don't need mortgages. So,
Right.
and if they had a credit score, I'm sure it would be off the charts. But,
Yeah.
yeah, it speaks to, this is more supported by, blocky foreign institutional buyers. It's not bottom feeding. It's far different than it was in '08. The only commonality really between this market and '08 is that prices are going up.
Yeah.
You know.
So I guess we feel generally that the sort of the demand side of the equation is probably here to stay for a while, and might even get more frothy as more institutional investors come in. With interest rates so low, you need better yield, and you can get some attractive yields in this space.
Yeah, exactly. And the things you would worry that would, tip the apple cart here would be, is the supply response too strong? Do home builders start flooding the market?
Mm-hmm.
Probably unlikely. Or do mortgage rates rise so rapidly that it prices out non-institutional buyers? Also
Right.
unlikely. So these dynamics, you see, they have a pretty long runway, and we have a pretty good line of sight into them. And how this factors into, on the investment side, when you think about a diversified portfolio, well, the largest components in the CPI basket are rent and owner's equivalent rent. So basically are tied to housing prices and rents. So, this is definitely supportive of these price gains we've seen, these price increases we've seen in housing are going to contribute to that large shock in inflation that we're probably going to get mid-year here in 2021. And then as we get through that, you just hope that supply meets the demand, and you don't get runaway inflation of owner's equivalent rent or shelter. So.
Yeah. It's this is where, when people say where's the inflation, this is where it's been, right?
Yeah.
So a question that a lot of people have started to ask me is, geez, should I even be buying a home? Maybe I should just rent. And what is the thought process behind tipping me one way or the other?
If large institutional buying is going to be a thing, and the single family rental market is going to be a new sovereign wealth asset class, then in theory, that should put upward pressure on prices and potentially downward pressure on rents. Because what you've done is you've created demand for single family homes, the price would go up, and you're exchanging that for uncertain demand for renters. You ultimately
Right.
want people to come and rent that house, but it's tough to say what the demand for renting those homes will be given the huge increase in supply. So that's an interesting strategy. I wouldn't be surprised if there is an opportunity there where you can sell your home and get it. You're going to get a good price. It's probably going to sell quick, and then go out and see if there are more attractive rental opportunities, particularly after there's more of a supply increase due to the single family rental market booming.
Yeah. I think this country's been built on the foundation of home ownership, and that's what everyone should strive for. And to some degree, if you think about it, it has probably been the largest wealth builder for individuals, in this country. So if you're taking that away from people, what is that doing from a societal standpoint? We're pricing people out of the home ownership market, and what
Yeah.
will that do for them for generations?
Well,
Maybe tackle that question.
you take your down payment and you open up a Robinhood account, and there you go.
Buy
Now
some GameStop.
the new greatest wealth builder of this generation, right?
Yeah. So it'll be interesting to see how this all plays out, because there's a lot of things going on, and whenever you have big institutions enter the market, I agree with you 100%. You've probably set a floor on prices, and there's going to be continued upward pressure. And I don't think we're even in the first inning of these institutional investors getting into the single family rental market.